Right, morning everybody, and thank you for waiting, and welcome again to the webinar. Charlotte and I are going to spend about half an hour, 45 minutes talking about growth shares and joint ownership.
Morning everyone.
We'll go through using the slides as a basis for talking. We will no doubt put in other points as we go through, which hopefully will be of interest. So looking first of all at the introduction, just to give a bit of background. I think that the starting point is to recognise that growth shares and JSOPs, joint share ownership plans, are both a form of growth interest. So the concept, first of all, of what a growth interest is essentially an award of normally shares or an interest in shares, where the recipient has a very low initial value, or it's intended they have a low initial value, but with the potential for significant capital gain. And in tax terms, what that means is that, by contrast with an unapproved option, the design is that the growth element will be taxed as capital gain rather than as income, with 28% tax or maybe a lower rate of tax depending upon the precise structure. What that means is that growth shares and JSOPs are similar in principle, but they do have important differences in their design and their implementation, as we'll see as we go through the detail. Now, many of you will have seen a similar slide to the one in front of you now before, because one point that I always raise when companies come to me to talk about the design of incentive plans is that although I am by training and many years practice a tax person, the starting point shouldn't be tax. The starting point should be the commercial issues about what the company is trying to achieve. How do they want to incentivise employees? Think about what are appropriate performance targets. Think about questions, commercial questions as to the maximum value employees should receive if they fulfil their performance targets. And within that, consider some of the more knotty issues in terms of, still looking at commercial rather than tax. What happens if there is partial success? Is it an all or nothing plan? How should success and failure be measured? All of these points will come up, in my view, should come up in every share plan which is considered. And the point that I'm making here is that growth interest and JSOPs are no different. So how is value going to be realised, particularly for private companies, is a key question. There's no point in having a share plan if at the point of exit there is no way for individuals to be able to convert their value into money. And that can have, not only can that undermine the incentive, it can actually have a negative incentive effect. So how is value going to be realised? What does an exit look like for participants? And for remembering within this that growth interests are designed to encourage employees to work towards future goals, not to reward them for past service. So there's another point there in terms of the design. Is the plan designed to achieve that, or is it designed to reward people for what they've already done? So they are some of the background and sort of initial thinking that should be considered. Now, having said all of that, tax is important. It should be secondary to the commercial issues, but nevertheless what we're here to talk about in reality is the tax position. So the tax thinking is that both with growth shares and JSOPs, and we'll come on to talk about JSOPs in a bit more detail in a few minutes, the objective is to recognise that there will be a tax charge on the making of the award, but it will be on a low initial value. So that there's a recognition that either tax is paid on that value, or alternatively the individual pays that value for the acquisition of the growth interest in order to get capital gains tax going forward. Similarly, corporation tax will be available. We said, well, it probably ought to be, depending on circumstances. It does depend on the corporate structure, on the initial low value which is subject to income tax, because you're aiming to get the value to be low in order to get the most effective income tax and personal tax treatment. The real point there is that corporate tax relief will be at best limited and quite possibly not there, so that looking at the overall assessment, it's taking into account the potential savings in income tax and national insurance contributions to be set off against the loss of corporation tax relief. With falling corporate tax rates, though, that becomes less of an issue, and the upside is that the future growth in value would be subject to capital gains tax on disposal, and the default rate for a top rate taxpayer would be 28%. But when we're looking at growth shares rather than JSOP awards, then it may well be possible, depending on the circumstances and the commercial context, to be able to ensure that the holders of the shares do benefit from entrepreneurs relief and therefore access the 10% entrepreneurs relief rate, provided that the employees hold at least 5% of the share capital by reference to voting rights and nominal value. So we've certainly seen many occasions where shares which have an economic interest of less than 5% nevertheless carry 5% of the votes, and by doing that and satisfying the other requirements for entrepreneurs relief, get into the 10% entrepreneurs relief rate. So what are growth shares and how does one go about establishing them and creating them? Well, the key point is that unlike JSOPs, what we're talking about here is a separate class of share. It's a special class of share which will entitle the holder to share in a designated proportion of the value of the company. Often these are exit-based plans, and where I've seen them apply most frequently, but by no means exclusively, is in the context of private equity transactions, where the commercial reality is that the private equity investor would not wish the participants to realise value unless they are also realising value, and therefore, quite aside from any tax structuring, the plan would be linked to achieving an appropriate form of exit. Now, there are a couple of additional points there in terms of the linking with individual performance targets. And the preliminary point there is that in most cases I would say that imposing individual performance targets is not necessary commercially. When you think about what's being achieved with the growth share, economically it's a bit like an option. So in other words, there is going to be no value unless the company increases in value, and therefore there is an implied performance target inherent in the nature of the growth share and the growth interest. But there are circumstances occasionally where the company or the investors wish there to be individual performance targets imposed. No reason why that can't be applied. However, the point to remember is that they will be almost certainly considered to be restrictions for the purposes of determining the initial taxable value. So that what we're then looking at is something which, assuming that the employee and employer elect under 431 to be taxed on the full unrestricted market value, I'll talk about that in a second. In effect, what is going to happen is that any depreciatory effect of those restrictions is not going to be taken into account when determining the tax value. So what that means is that the restrictions do not create a problem from a tax point of view, provided that they are drafted correctly and implemented correctly, but they're not going to improve the tax position either, because in effect they'll be ignored for determining the tax treatment. And that gives flexibility in terms of the targets, because there's no great tax magic to be satisfied. So there could be stage targets with employees, for instance, benefiting from a greater share of a company value, greater threshold values are met. And if you're looking at generic performance targets of that sort of nature, it might be that they are capable of being structured in a way which is not a restriction and therefore do impact on the value. Now, I've already made reference to Section 431 elections, and this is a number which is known and talked about by many people without necessarily understanding exactly what is involved with the Section 431 election. The essence is that the employer and the employee jointly elect that when determining the amount of value which is going to be taken into account for assessing the tax liability on the acquisition of the shares, all restrictions are ignored. Now, what does that mean? Well, what that means is if you have something which is personal to the individual, even if it's in the articles, the effect is going to be that the restriction would not be taken into account in determining the value. So for instance, if you had something which said that the employee will forfeit these shares if they leave within 3 years of the shares being acquired, and there's a Section 431 election entered into, it doesn't really matter where that restriction is contained, because it's personal to the individual, it's not inherent in the shares, that will not impact on the value. So why would you want to do that? Well, the reason why you'd want to do that is because you want to get into a position where the full gain on realisation is subject to capital gains tax rather than on income tax. And the effect of the Section 431 election is to say just that, provided that when the shares come to be sold, they are sold for no more than their market value, then the expectation in the totally normal case is that the entirety of that gain will be subject to capital gains tax at the reduced rates and will not be subject to national insurance contributions. So that's why Section 431 elections are entered into. It's a joint election. It's entered into between the employer and the employee jointly, and it has to be entered into within 14 days of the shares being acquired. No requirement to deliver those to HMRC, so they need to be made and then put somewhere safe, but if they're not made within 14 days, then they're not effective. So the effect, as I say, is that the employee will pay tax on the initial UMV, and that's another phrase used frequently. UMV stands for unrestricted market value, and is just the form of the market value I'm talking about, ignoring restrictions. But we would still expect that to be low, subject to the commercial details of the share rights relative to an ordinary share, because you don't know whether those targets are going to be met. You would probably, I'll come on to talk about valuation towards the end, but what you're looking at in effect is the prospect of the future target being met, looking at the potential value, and provided that the targets are sufficiently stretching in terms of value growth, we would expect there to be a low upfront value and therefore a low upfront amount subject to income tax charges. Now, one question which we come across periodically is how does HMRC view these forms of interests? And there's a research report 372, on the use of all forms of growth shares. Now, it's a slightly odd document in a sense in that it's published by HMRC but was not written by HMRC, and therefore in theory the views expressed in the document do not necessarily reflect those of HMRC. However, I think it's a reasonable assumption to make that HMRC would not disagree fundamentally with the comments made, because if they did, they wouldn't have put their name to the report. And the key point is that there is no suggestion that growth shares per se, or growth interests, are viewed as abusive. And we periodically have clients and potential clients who look at the benefits of operating growth shares or JSOPs, and they express concern that because there are potentially significant benefits, that must be some form of tax avoidance. And the answer is that provided that we are looking at something which is commercially driven, it's not trying to find any loopholes or do anything which is contrary to the intended purpose of the legislation, we should not be viewing this as a form of tax avoidance, and that is confirmed by HMRC. It was a fairly detailed process by which the report was written. Lots of advisors and companies were interviewed, and the content of the report demonstrated a reasonably detailed knowledge of the way that growth shares operate and are used. So I think that you could look at that and take a fair degree of comfort that this is not something which ought to be causing concern from the point of view of abuse or tax avoidance. Now, just going on to look at some areas of interest, shall we say, there is a debate over the difference between a restriction and an inherent characteristic of a share. Now, this comes back to the point I was talking about earlier in terms of determining the amount on which the taxable value is determined. Remember that a restriction is ignored, whereas something which is inherent is not ignored. And I think the key point here is that I think caution needs to be adopted, because some advisors will say that anything which is put into the articles will not be a restriction. and a reference is made to support that view to a tax case a few years ago called Gray's Timber. And what Gray's Timber was looking at was actually the question of whether a purchase price at a whole company value would be accepted as being market value or more than market value. And the point being that if it was more than market value, the excess over the market value would be subject to income tax. And the facts of that case were, in a sense, the other way around. This was provisions which were not in the articles, and as a result of not being in the articles, or at least partly as a result of not being in the articles, the terms on which the shares were sold were found by the court not to reflect the value of the share, and as a consequence were subject to this tax charge. Many people have taken that and turned it round the other way and said, well, that means that if the provisions are in the articles, then they must be part of the share, and they're inherent part of the share and not a restriction. I think that's taking it too far. Essentially the question is, would the right restriction impact on the value in the hands of a third party purchaser of the share as a result of being inherent in the share? So to take a very simple example, going back to the fact pattern I was talking about a few seconds ago, if what happened was that there's a special class of share issued, it was issued to an employee, and the terms of the share said that if that employee leaves employment, i.e. a named person leaves employment within 3 years, the shares will be sold for no payment back to the company or at the direction of the company. That's still in the articles, but it's still a restriction. And therefore the principle is, are we looking at something which is personal, or are we looking at something which is inherent to the shares themselves and will attach to all shareholders? The experience we have is that provisions in articles tend to be complex. There's no inherent reason why that should be the case. It's just that the ability to have flexibility, which is given by growth shares, also offers the opportunity to create complexity. My counsel would be to minimise the complexity. I think that there are lots of dangers with complex articles. It means that they take longer to finalise. There is a greater risk that the end result will not reflect the commercial intention, because the commercial intent gets lost in the detail of the complexity. And there's also a significant risk that they lose their incentive effect. If you think about this from the point of view of the participant, if you receive a share which says that the company is worth £10 million today, and you will participate in any sale proceeds of the company in excess of, let us say, 12 million, that's easy. Commercially, that's easy to understand. If you introduce all sorts of complex measures of value, you have all sorts of EBITDA definitions, and those need to be understood in order to understand the articles, a participant may look and think, I don't understand that, and if they don't understand it, they will not be motivated or incentivised, and the effect will be that the growth shares will not achieve their purpose. And what that means is that the shareholder is not achieving the hoped for impact on behaviour. It's not going to drive the value of the business, and if and when the business is sold, the individual is effectively getting the value for nothing, or to be more precise, the shareholder is giving the value away for nothing, because they haven't got the benefit of the motivation in the meantime. So that's an important point to think about. Growth shares, we've said may, I'd say probably will, require amendments to the articles to create new classes of shares, if you're going to allow new joiners to participate. Will might be too strong. There's actually a debate underlying that bullet point as to the extent to which share rights can be drafted to include flexibility for new joiners. I have seen that happen, but in most cases what tends to happen is that you have one award with new joiners then having a new class of share with different commercial rights. What is the initial taxable value? Well, if the company value is, to take the example there, 25 million, and shares only participate in value above 30 million, HMRC used to accept that the shares would have negligible initial value. If today's value is 25, how can something which doesn't participate in anything until the value grows to by 5 million, by 20%, have current value? Well, the revenue are challenging that, and I'll come back to look at that towards the end of the webinar. What the revenue are now doing is more having a sort of expected return calculation. So what are the shares likely to pay out if targets are met? What discount is appropriate for the risk that targets will not be met? That now tends to be more the approach of HMRC, and therefore that it implies a deeper consideration of the true economic value of the share, a true assessment of what is likely to happen with the share, and we'll come on to talk about the way the revenue are sort of stepping back from agreeing values up front, but getting that right is a key part of structuring your growth share. The other side of that equation is that, as I've alluded to already with the references to the Gray's Timber case, if the shares ultimately are sold for more than market value, the excess over the market value would be subject to income tax rather than capital gains tax. And therefore, to that extent, a sale for more than market value would not achieve the intended purpose of getting into that favourable CGT regime. Final point now I will talk about in more detail when I come back to talk about valuation at the end. Now, I'm going to talk very briefly about employee shareholder shares. I'm not going to spend very long because we have looked at this in detail in our November webinar, which I think is still available to listen to on the web, and I think our webinars now appear on YouTube, so it can be gone back to. But the point here is that employee shareholder shares can take the form of growth shares, and all the rules that we talked about there in terms of the first £2,000 of shares being free of tax, that gains on sales of shares with an initial value of no more than 50,000 can apply, and in my experience will normally be structured so that the awards are in the form of growth shares to growth shares. And one key point here in terms of valuation is that, and this is still the case, that the revenue will agree the initial value of the shares before they are issued. Now, I will come back later to talk about valuation, but now I'm going to ask Charlotte to enlighten us on JSOPs, joint share ownership plans.
Thanks, Stephen. I'm going to start by saying I've set out various details about the legal form of joint ownership on that slide. But to begin with, in some ways that isn't actually the most relevant point. The point is that this is a growth interest in the same way as growth shares. The employee gets no or a purely nominal share in the current value, say a tenth of a penny per share, and then they get a share in the growth in value of the company going forward. So when I talk about co-ownership and beneficial interests, in a sense that's a side point, because what I mean is that this is a growth interest in the same way as growth shares. Having said that, I will actually tell you what joint ownership is at this point. It's not an award of shares for an employee, it's not a share option, it's not a growth share. It's the employee gets a share, but they get it in common with a co-owner, and there is a contractual agreement between them as to how the interest in the share is to be divided. What I mean by that is, you take an ordinary share in a company, you issue it, or you can use an existing share, you transfer it into the joint ownership of the employee and a co-owner. That's usually an employee trust, doesn't have to be, I'll come back to that. So they both hold it in much the same way as people might hold property with their spouse, or any other form of, the legal term I'll use is tenancy in common. The essential point is, no, it's not that the employee owns half of it and the co-owner owns half of it, it's that they both own the whole thing. Then there is a joint ownership agreement. That is a contractual document. What that does is not say the employee owns half and the co-owner owns half. What it says is they both own the whole thing, but when they come to sell it, there is an agreement between them as to how the proceeds of sale are divided. And the way in which those are divided up is to say the co-owner receives the initial value of the share, plus something called a carry charge that I'll describe in a moment, and all the employee gets is any proceeds of sale reflecting the growth in value of the share since the award was made. I've got a diagram here. If I've talked about joint ownership to you before, you may have seen it before. Essentially, this sets out the essence of how it works. As you'll see, the main point here is that the co-owner gets all that upfront value, but doesn't get anything much else, and the employee gets the growth in value, but none of the existing value. The co-owner also gets something called a carrying cost. What that means is, the way joint ownership works means that you do need to issue the shares to begin with, and then you have the current value of those shares sitting around tied up in the co-owner's hands. So, for example, stuck in an employee benefit trust. That obviously has a cost to the company, and so the carrying cost essentially represents a sort of interest that the co-owner gets on that value. And then when you come to sell, the co-owner gets the upfront value plus that little carrying cost, and the employee gets the gain. Hopefully it will in fact be as or more substantial as is shown on that slide. How does the tax work? It's very similar to growth shares. Again, the employee gets a very small initial value. They pay income tax on that initial value, and then they pay capital gains on the value going forward, which is a natural result of how the tax code works. The employee isn't actually getting very much up front, so they don't pay income tax on very much up front, and their capital gain is then taxed under the capital gains regime. You do need to make a Section 431 election in the same way as for growth shares. That's because you want to make sure that all your income tax is charged at the beginning when the employee is getting a low value, and not 3 or 5 years down the line when awards are being realised and income tax could potentially be charged on much higher values then. The nice thing about joint ownership is that the terms are all in contract. So it's very flexible, it's very easy to include whatever conditions you like. If you want to say the employee if you want to include specific terms about vesting, if you want to include an arrangement where if performance targets are met, the employee will get different proportions of the growth in value, that can very easily be done. You don't need to change the articles, so you don't need all the hassle of shareholders' resolutions necessarily. You don't need, and it is in practice often much less complex. Again, as Stephen made the point, there's no particular reason that growth share articles should be complex. In practice, I have yet to do any growth shares where the articles haven't involved quite a lot of detail, whereas joint ownership sometimes is genuinely quite a straightforward contractual document. And another advantage to point to here is that it's usually the co-owner who holds the legal title of the shares. The employee gets a beneficial interest, and so it's a co-owner who appears on the shareholders' register, and that's quite straightforward to deal with in administrative and in corporate governance terms. The tax analysis, as we've said, it's actually David and William of our firm who first came up with it and went to HMRC with it, and HMRC are very comfortable with its use. And there's also a valuation method that William Franklin of this firm worked together with HMRC to come up with the initial value of the joint interest. And again, HMRC shares and assets valuation are very comfortable with that. As I've said as well, just that final bullet point is just coming back to the point that because the co-owner is the legal owner, because it's just an ordinary share, it's all very straightforward to deal with on any corporate event. You just treat the shares in the same way as all the other shares in the company. So what are the disadvantages of joint ownership? Are there any reasons you might not want to do it? As I've said, it does tie up the initial share value. It can in a way be an advantage because you can simply use existing shares, and obviously, particularly for listed companies, there are often limits to the use of newly issued shares in employee share schemes that apply less strictly to the use of existing shares. If you are using newly issued shares, you do have to think about essentially what's the economic analysis here. If the co-owner is an employee trust, you need to fund them to purchase the shares up front. You can do that simply by issuing the shares at nominal value to the trust, but that means that effectively that value is then in the trust forever. you may be able to loan the money to the employee trust to subscribe to the shares at their full market value to begin with, but then that means that there's an increasing amount of increasing amount of value tied up in the trust at the outset. While joint ownership is in some ways very easy to structure in terms of you can be very flexible, you can give the employee essentially whatever you like in terms of performance conditions, etc., it is at base an ordinary share, and all the employee gets is the growth in value of an ordinary share. So often with growth shares you may see conditions where, for example, if the value of the company increases by a certain amount, the employee gets X percentage. If the value of the company increases by a greater amount, the employee gets a greater percentage, but is rather more difficult to do with joint ownership. Again, what happens if the performance conditions unfortunately aren't met, or the value reverts back to the co-owner? That means, particularly if you're using an employee trust as the co-owner, that can end up with quite a lot of value being trapped in the employee trust. And you can clearly use that for future share awards for employees, but it is a point that you need to think about in advance rather than waiting until the problem arises. If you are a closed company, that is a company controlled by 5 or fewer shareholders, or by shareholders who are all directors, any loans to the employee trust to fund the initial acquisition of shares for use in joint ownership will attract a 25% upfront tax charge. That's repayable at such a time as the loan is actually paid back, but companies, for obvious reasons, often would prefer not to have to take that charge up front. And there is also an upfront cost of participation to the employee in terms of the tax, in terms of either they pay for their interest or they pay tax on that initial interest. Usually the value of that upfront is quite low, but that is effectively a dry tax charge or a cost to the employee at a time when they're not getting any value until the scheme is actually realised a few years down the line. So it does need to be considered. I've just put a slide on here about joint ownership of shares in a subsidiary. I've been talking about joint ownership where shares are owned by an employee trust. That can involve a fair amount of complexity, as I've gone through. Doesn't have to, but quite often does. This is just an illustration of a situation which it can be done very simply. You use the shares in a subsidiary of a company. You issue the parent acts as the co-owner. So effectively, the parent company continues to be the 100% legal owner of the subsidiary. You award a beneficial interest in the growth to employees, and then when it comes time to realise value, the parent simply buys back the employee's interest. That's not a company buyback of own shares, that's a buyback by the parent, so you don't get into the same rather difficult administrative provisions. One point of complexity there is, if it's shares in a subsidiary, firstly you need to be clear that it's the subsidiary that will increase in value and not the parent company. And secondly, you will be awarding a minority interest to your employees of, say, a very small percentage of share capital. If you then expect to buy back the shares for their full value from employees, that is to say their value is represented as a percentage of the whole company value, and not as a value that reflects the fact that actually a small shareholding in a private company isn't necessarily very valuable at all on its own. Is that actually the market value of a share? Because if not, you are into income tax charges on the much greater value once it's grown a few years down the line. It can be worked around, but if you seek to award shares at the outset for their minority value and pay tax on that value, and then to buy shares back from employees at their pro rata value, HMRC may take a rather sceptical attitude to this. I'm going to pass back to Stephen now for a comparison of growth shares and joint ownership.
Okay, thank you very much, Charlotte. Many of the points flow from what we've already said in terms of the detailed description of the way that growth shares and JSOPs work. But just to recap, the first key point is that growth shares do require changes to the articles. A JSOP is all in contract and therefore the documentation is easier. JSOPs require a joint owner, either an ESOT or an existing shareholder, and that needs to be dealt with some care, because if you're looking at a co-owner who is not an ESOT, that person will have their own commercial interests and their own commercial concerns, and that can then generate practical complexity rather than anything which is conceptually difficult. It's more normal to use an ESOT. When we're looking at an ESOT, an employee share ownership trust, that implies an independent third-party trustee, which will typically then involve trustee costs, so there will be ongoing costs. There are the tax issues with the funding of an ESOT, which Charlotte referred to in the section on JSOPs. Essentially, a loan to an ESOT, if the company is a closed company, gives rise to a temporary but potentially long-term 25% tax charge. Use of an ESOT also creates potential issues under the disguised remuneration rules, provided that the JSOP is structured properly. Shouldn't really be a concern in most cases, but it does need to be thought about. JSOPs are probably easier to administer on a corporate transaction or an exit event. The contractual documentation defines how the individuals are going to participate in the exit proceeds, and in many ways just having one shareholder in terms of the shareholder on the register who's going to have to deal with all of the process with the takeover may well be more straightforward. Conversely, in order to secure the 10% tax rate for entrepreneurs relief, it is easier to use growth shares giving a 5% interest. And I haven't seen a JSOP which has been structured to access entrepreneurs relief. I've seen many forms of growth shares which do exactly that. Growth shares allow more easily for ratchet arrangements, sort of performance target arrangements and differential participations that we've touched on already. That's easier to achieve with growth shares, but equally it may be more straightforward for other forms of performance conditions to fit into a JSOP, as everything is in contract. There's nothing conceptually difficult with putting performance conditions into growth shares, but the practicality of the documentation might fit more easily with a JSOP. Personally, I think that the big distinction between growth shares and JSOPs is covered by the final bullet point. That if you're looking at a listed company, then it is easier to use a JSOP. And if I just explain that, it is not true, I've heard many people say that it's not true, that you cannot use growth shares for a listed company. And I can say that it's not true because I've seen it happen, and it happened effectively, but it does get much more complex, and the reason is fairly obvious when you think about it, which is that a listed company will have its shares traded. It's the stock exchange market which provides the market for those shares, but they'll only be able to trade the one class of share, the ordinary shares. And what that means is that if you have a growth share, you need to have some sort of mechanism to convert the growth share into the ordinary share, and that point of conversion is something which can give rise to a tax charge. There is a taxable event on the conversion of a convertible share. Now, whether that then creates a real issue depends upon how the conversion mechanism is structured and what value there is in the actual conversion. And I've seen cases where those issues have been successfully addressed, but it is more complex than using a JSOP, where in essence all that is happening is that ordinary shares are being used and the interest in those ordinary shares is being carved up between the employee and the joint owner. So I think it's horses for courses. There'll be some cases where growth shares are right, some cases where JSOPs are right, and the key point is to think carefully about that before deciding which path to go down. Now, just to bring matters to a conclusion, we've got a final slide on valuation. And I've talked throughout about the fact that for both growth shares and JSOPs, the initial tax charge will be on the market value of the share as defined in the tax legislation. And what would be expected would be that when we're looking at all shares in a private company which are minority shares, but that includes employee shares, that the valuation will be at a significant discount to the market value. And this takes account of lack of marketability. It's not actually just marketability, it's lack of influence. If you hold a minority shareholding in a private company, there's not a great deal you can do to actually affect the way the company is run. and therefore you would expect there to be a minority discount. However, where shares are sold to a majority shareholder, should that sale value reflect the value in the hands of the buyer, i.e. be for a pro rata value? And that's quite a big question. We've been debating it in the office this week in various different contexts, and it's certainly a topic which I could quite easily spend another half hour talking about, but won't. I think it's just important to recognise that up front when thinking about the valuation of the shares when they are acquired and how it's going to work when they come to be sold. Because the point which I think is important is that whatever the theoretical analysis and theoretical detail, it has to be assumed that if you apply a minority discount when the shares are acquired, that the revenue would expect consistency unless the facts have changed when the shares come to be sold. So if you acquire shares, minority shares, you may get a discount. If you sell in the context of an exit, maybe you can say that the facts are different. But if all that's happening is that you're acquiring the shares and then realising them under the arrangement in place when the shares were created, it's difficult to justify an inconsistent treatment. If what happens is there is a sale which is for more than market value, then the excess will be subject to income tax on the excess. So what we're saying there is if you have shares which you ought to be treated as having a minority discount of, let's say, 75%, which is not unusual, and the shares are held are sold for a pro rata value, ignoring that 75% discount, 75% of the sale proceeds are subject to income tax. So it's an important point to think about when structuring both the acquisition and sale of the shares. Normal principles apply. Shares are valued on the basis of what a reasonable purchaser would pay on an arm's length basis. What we have with HMRC, though, is an established methodology for valuing JSOP awards, which is the expected return methodology, or ERM. So what that says in essence is, let's look at these shares, what might they pay out, what are they expected to pay out, over what time period, what are the risks during that time period of them not paying out, we'll discount for those risks, but having completed that process, the resulting expected value with discounts would then be the value to be applied. And now you can perhaps see, going back to the slide I was talking about earlier, when I said that the revenue used to accept that if you had a significant hurdle to overcome before the shares could be seen to be in the money. I think the example we had was going from 20 million to 25 million, or 25 to 30 million, that there would be no value. That's what the revenue used to do, but now they're more looking at and saying, well, what are the chances that you're going to get above that 30 million threshold? And if you tell us, if you, the advisor, you, the company, tell us that there's very little chance at all, we're a bit sceptical, because we're not quite sure what the point then is of creating these shares in the first place. So there is much more rigour and depth required in valuations than used to be the case. And we're also seeing a similar approach with growth shares, of the revenue looking to value growth shares by reference to the expected payout, discounting for uncertainty, and discounting for all sorts of other risk factors, so still coming down in fact with a very low value, but nevertheless looking at things in much more depth, requiring forecasts, and the valuation becoming a much bigger and more significant exercise. The penultimate bullet point, or the last two bullet points, would not have been in the presentation if we held it last week, and the reason for that is that there was an announcement from HMRC this week of removing PAYE health checks and PTVC, post-transaction valuation check, agreements with HMRC. We haven't quite absorbed the full implications of that yet, and again, it is another topic which we could spend a lot of time talking about. Suffice to say, I think it will have a substantial impact on the way that growth shares and JSOP arrangements are implemented, because the use of the health check, in particular the PTVC, which was a mechanism which allowed taxpayers to agree the value of shares with HMRC in a form which would be determinative for individual tax returns, has been a key part of the way in which growth shares, JSOPs have been structured, more growth shares than JSOPs, and we and our clients will need to think hard about the resulting risks and how to manage those risks and how to look at the valuation in order to have confidence that it will be accepted by HMRC on a consistent basis, and to a large extent that's still being thought about and considered. One practical point to finish on is that Advance Agreement is still available for ESS, Employee Shareholder Status Awards, and what that does is to place more emphasis on the value of that agreement for ESS, and therefore using ESS shares over and above the pure tax benefits of the initial £2,000 tax-free amount and CGT relief for shares worth an initial 50,000 or less. Well, that finishes 45 minutes. Thank you very much everybody for listening. I hope that you found the webinar useful. As ever, if you have any questions, do feel free to contact us. The contact details for all of us are on the slide in front of you now, both the email address and phone numbers. Do please come back if you have any questions you'd like to put to us. Otherwise, we look forward to seeing you or hearing from you in the next webinar at the beginning of March. Thank you very much.
Thanks everyone.